Hey everyone, welcome to today's Explainer. We've got a really fascinating one lined up for you, breaking down the massive news and Q1 2026 financial results for Two Harbors Investment Corp. They trade under the ticker symbol 2W. If you follow the real estate investment trust space, or honestly, if you're just hunting for compelling market maneuvers, this one is a wild ride. We are talking about a major acquisition, terminated agreements, diverging accounting metrics, and a fiercely loyal institutional base. There's a lot to unpack here, so let's jump right in. Let's start things off with a question that has pretty much been on every dividend investor's mind this entire quarter. What actually happens to your portfolio when a high-yield darling, we're talking about one throwing off an 11% yield, suddenly announces it's being taken private? Well, for Two Harbors, the first quarter of 2026 was defined by exactly this scenario. And it all really comes down to this specific number, $11.30 per share. That is the amended cash consideration price that CrossCountry Mortgage, or CCM, is paying to acquire Two Harbors. Now, this isn't just your standard buyout. It's an all-cash deal, and it completely changes the trajectory for current shareholders who were maybe sitting on this stock purely for those long-term dividend payouts. What's really interesting is how this buyout actually evolved. You can see on the left, Two Harbors actually terminated a prior merger agreement with UWM Holdings. That one was set up back in December of 2025. Then they completely pivoted to this new, much sweeter definitive agreement with CrossCountry Mortgage on the right. That pivot bumped the per-share cash consideration up to that $11.30 mark from an original $10.80 offer. It is just a classic textbook example of competitive corporate maneuvering to maximize shareholder value right before an exit. Section 1. Understanding Two Harbors, the MSR-focused REIT. Okay, so now that we know the climax of the story, the big acquisition, we really need to take a step back and look at the context of the business itself to make sense of their financial turbulence. As you can see, Two Harbors uniquely positions itself as an MSR-focused REIT. So they aren't out there buying up shopping malls or massive apartment complexes like your traditional real estate investment trust. Instead, they operate in a highly specialized, highly paper-driven corner of the mortgage market. To really grasp what they do, we need to quickly define what that actually means. MSR stands for Mortgage Servicing Rights. Basically, when a mortgage is created, the right to collect the processing fees, to manage the escrow accounts, and to handle customer service, that's often split off and sold entirely separately from the actual underlying debt of the house. Two Harbors buys those rights. They don't take on the primary default risk of the home loan itself. They simply collect a steady, contractual fee for doing all the administrative heavy lifting. And if we look at the underlying health of their MSR portfolio as of March 31st, 2026, the metrics show a surprisingly stable asset base. During the quarter, they added $151.8 million in unpaid principal balance through flow sale acquisitions and recapture. Their portfolio is sitting on a weighted average gross coupon of 3.54% and a super low 60-plus day delinquency rate of literally just 0.18%. Plus, their 3-month constant prepayment rate, or CPR, sat at 5.6%. All of this basically tells us that the core engine of their business is humming along smoothly. Moving on to our next section, the Q1 2026 financial snapshot, exploring the GAAP versus non-GAAP reality. You know, headline numbers can be super deceiving if you don't know exactly where to look. This really clarifies the stark contrast between standard accounting rules and actual cash generation. On paper, Two Harbors reported a GAAP comprehensive loss of $24.7 million. Now, if you just stopped reading there, you'd probably panic. But look at the right side. Their non-GAAP earnings available for distribution, or EAD, was a positive $35.8 million. That breaks down to 34 cents per share. And for a REIT, EAD is absolutely crucial. It's the lifeblood metric because it represents the actual cash profits available to hand out to shareholders. It completely changes the narrative of the entire quarter. What's really fascinating here are the exact components that dragged that comprehensive income down into negative territory. Notice how their net interest and servicing income were actually quite strong, but they were heavily offset by mark-to-market losses on their investment securities and servicing assets. Because they have to account for MSRs at fair value, any shift in interest rates or overall market volatility forces them to write down the paper value of those assets, even if the actual cash coming in the door hasn't changed at all. So, translating all of this to the bottom line for the shareholders, the book value landed at $10.57 per common share at the end of the period. When you factor in the dividend, this represents a negative 2% quarterly economic return on book value. It's a slight dip for sure, but it was primarily driven by those non-cash mark-to-market accounting adjustments we literally just talked about. Next up, the dividend story. Let's be real, for most retail investors, the main draw here has always been the dividend. It's the whole reason you buy into an MSR REIT in the first place. So let's unpack that story and see how well it's actually covered. Check out the relationship here between their fluctuating comprehensive income and their impressively consistent dividend declarations. While the comprehensive income swings wildly from huge losses to big gains quarter over quarter, the dividend they've declared remains a perfectly steady flat line at 34 cents per share for the last 3 quarters. It clearly shows management's commitment to returning cash, totally regardless of paper volatility. And that brings us to this absolutely massive number, an 11.9% annualized dividend yield. That's based on their declared 34 cents per share first quarter dividend. Remember earlier when we noted that their earnings available for distribution was exactly 34 cents per share? Yup. That means their dividend is perfectly covered by their core operating earnings this quarter. Nothing to worry about there. But naturally, you're probably wondering, what happens to this massive yield now that the company is actually being sold? Well, management explicitly states that Two Harbors intends to pay regular quarterly dividends consistent with past practice for all completed quarterly periods prior to the closing of the merger. So no, you aren't getting cut off immediately. The income stream continues while the deal works its way through all the necessary regulatory approvals. Which brings us to our final section. What happens next? The resolution. Let's map out exactly how this transaction is going to unfold from here. Right now, we're at step 1. Digesting the Q1 results from April 2026. Next, those regular quarterly dividends will just continue to roll in. Then, as we look ahead to the close, it's not just common stockholders getting paid out. Holders of 2 Series A, B, and C preferred stock will have their shares fully redeemed at $25 per share, plus any unpaid dividends. Finally, the entire transaction is expected to formally close in the second half of 2026. But here is where things get kind of wild. The stock market is processing all of this in real time, and it's creating a truly fascinating dynamic. As of late June 2026, the shares were actually trading around $12.32. Now, think about that. That is notably above the $11.30 CrossCountry cash offer price. This is being driven by complex market dynamics. It's potentially traders pricing in the value of the accumulated dividends before the deal actually closes, or it's reflecting the heavy backing of institutional owners, who right now hold over 80% of the float. So I'm going to leave you with this final thought to ponder as we wrap up today's explainer. With the CrossCountry merger effectively capping the long-term upside at $11.30, plus whatever final dividends are squeezed out, does this signal the beginning of a larger consolidation wave for high-yielding REITs in today's economic climate? Two Harbors built a phenomenal MSR engine, and CrossCountry clearly saw the value in just buying it outright. It really makes you wonder which specialty real estate trust might be the next target on the block. Thanks so much for joining me today, and definitely keep your eyes on those yield charts.